One of the biggest free lunches in the tax code is something called tax loss harvesting. We like to say that we're really good at taking losses. And you might be thinking, wait, did this guy really just say they're really good at losing money? No. We're really good at using the tax codes to our clients' advantage to minimize their lifetime tax exposure. As a reminder, it is not the return that we make that matters, it's only the return that we get to keep after taxes that matters in the end. To illustrate this, let's forget about the stock market for a second and say you have 500 grand to invest. You go out and buy a duplex to rent out. On the street, there are two identical duplexes side by side, a green one and a blue one. Each is worth 500 grand. You buy the green one. After that, the 2008 global financial crisis happens and your green duplex isn't worth 500 grand anymore. It's only worth 300 grand. And of course, the one next door is also worth 300,000. You go ahead and sell your green duplex, which, gosh, that sounds really silly. You paid 500 grand for it and only sold it for 300,000, locking in a $200,000 loss. You tell your CPA, put that $200,000 loss on my tax return. The next day, you go out and buy the blue duplex next door for 300 grand because we're in a crisis and it's also down in price. To recap where we are so far, you bought for 500, sold for 300, and went next door and bought the adjacent identical property for 300 grand. Now, what happened after the 2008 crisis and after every single crisis in all of history? Prices recovered. So your duplex didn't just go back to 500 grand, it went up to 750,000 because of course all these properties are now up in value. So what happened here? Let's look at the end result for this investor. They put 500 grand in, and if we say today, what's your duplex worth? Well, it's worth 750,000. But on their tax return, they have a $200,000 loss. And that's the concept of tax loss harvesting. If one index goes down in price, we're going to swap it for another similar performing index fund. And when they both come up in price together, you have gains in the real world, but you have losses on your tax return. This is nirvana as an investor. It's one of the only free lunches in the tax code. The tax laws are set up in a way that allows investors to sell an asset down in value and buy another asset even if they perform nearly the same. One of the most frustrating things that we observe when a new family hires us is seeing their last couple of years of their tax returns and seeing, wow, they paid capital gains taxes that could have been avoided with proper tax management. At Brandywine Oak, we take advantage of the tax code to help our clients maximize their after-tax wealth and keep more of their life savings. Scan the QR code to see how we might be able to help.